The power of expectations markets don't just respond to what's happening now. They respond to what they expect will happen in the future. Central banks shape those expectations. When the Federal Reserve hints at raising interest rates, traders immediately adjust stock and bond prices to reflect higher borrowing costs. If the European Central Bank signals inflation concerns, investors brace for tighter policy. Even vague phrases like monitoring conditions closely can spook traders who fear hidden dangers. The panic isn't about the words themselves, but about what they imply for the future. Central banks control the narrative, and investors scramble to react before others do. Interest rates and borrowing costs. The core tool of any central bank is the interest rate. When central bankers hint at raising rates, it signals that borrowing will get more expensive. For businesses, that means higher costs for loans and slower expansion. For consumers, it means pricier mortgages and credit. Investors, anticipating lower profits, dump stocks, while bonds become more attractive as yields rise. A single comment about rate hikes can spark massive sell-offs. This sensitivity shows how dependent the economy is on cheap money. Words about rates matter because they directly affect spending, borrowing, and investing behavior across the entire financial system. Inflation fears. Inflation is the enemy of stable markets. When central banks mention rising prices, investors panic because inflation eats away at profits, wages, and savings. If a central banker signals concern, traders immediately price in higher interest rates to combat inflation. This double blow, higher costs and tighter money, spooks both businesses and consumers. For example, in 2022, the Federal Reserve's repeated warnings about persistent inflation sent stock markets tumbling even before major rate hikes happened. Investors panic not because inflation is already destroying value, but because central banks' words make them believe tougher policies are coming. Fear of the future drives the present panic. The central bank put. For decades, markets believed in the so-called central bank put. This meant that whenever markets crashed, central banks would step in with lower interest rates or money printing to stabilize things. But when central bankers hint that they might not bail out markets, perhaps because inflation is too high, panic sets in. Investors, accustomed to a safety net, suddenly feel exposed. The idea that central banks won't protect them causes overreactions, with traders selling off assets before the supposed protection disappears. Words questioning the safety net can be more powerful than policy itself. Confidence breaks and panic spreads quickly. Ambiguity and jargon. Central bankers often use vague, technical language designed to avoid commitment. Phrases like data-dependent, longer-term outlook, or transitory inflation confuse ordinary investors and even experts. This ambiguity creates room for multiple interpretations, which fuels panic. One investor hears slow growth and prepares for a recession, while another hears manageable inflation and buys aggressively. The uncertainty itself drives volatility. Ironically, attempts to calm markets with careful wording often backfire because people fear what they don't fully understand. The less clear the message, the more likely it sparks panic, as investors fill in the gaps with their worst fears. Historical precedents. Markets panic because they remember the past. Every phrase from central bankers is judged in light of history. For example, in 2013, the U.S. Federal Reserve suggested it might taper its bond buying program. Markets instantly sold off in what became known as the taper tantrum. Similarly, in the 1970s, weak central bank communication on inflation led to runaway prices and long recessions. Investors now react aggressively to avoid being caught off guard again. History makes them hypersensitive. Even when current conditions differ, echoes of past crises amplify the impact of every central bank word. Global ripple effects. When the U.S. Federal Reserve speaks, the whole world listens. That's because the U.S. dollar is the global reserve currency. If the Fed hints at higher rates, capital flows back to the U.S., weakening emerging market currencies and raising their debt costs. Central bank words in one country can trigger panics across continents. For example, a hawkish Fed statement might cause turmoil in Turkey, Brazil, or South Africa, even if their domestic economies are stable. This global ripple effect magnifies the panic as investors react not only to their own markets, but to expected chain reactions worldwide. Algorithmic trading. Today's markets are dominated by algorithms that trade in milliseconds. These systems scan central bank speeches for keywords like inflation, tightening, or uncertainty. When they detect negative signals, they automatically sell, causing sharp drops before human investors even react. This amplifies panic, as sudden market swings trigger emotional decisions among regular traders. What might have been a slow adjustment turns into a flash crash. Central banks know their words are parsed by machines, but they can't fully control how algorithms interpret them. As a result, even slight rhetorical shifts can unleash outsized market turmoil. Investor psychology markets are not perfectly rational. They are made of people, traders, investors, and institutions who react emotionally. Fear of missing out and fear of loss both drive panic. When central banks hint at danger, investors often overreact, rushing to sell before prices fall further. This herd behavior multiplies volatility. Even seasoned professionals are influenced by group psychology, not just analysis. A calm statement can be read as ominous if everyone expects bad news. Ultimately, words matter because they trigger collective emotions. Central bankers hold power not only over money, but also over confidence, and when confidence cracks, panic spreads like wildfire. The role of the media, financial news outlets amplify central bank speeches, often with dramatic headlines. A cautious statement like, "We are watching inflation closely," becomes, "Fed warns of rising inflation crisis." This framing feeds investor anxiety. The more sensational the coverage, the faster panic spreads. Social media makes the problem worse, as sound bites and quotes are shared without context. Central banks may aim for careful nuance, but once their words hit headlines, they take on a life of their own. Panic often starts not with the speech itself, but with the way it's interpreted and broadcasted to millions of anxious investors. Credibility and trust markets panic more when central banks lose credibility. If investors believe the bank is downplaying inflation or overestimating growth, they assume future policy will fail. Distrust magnifies the impact of words. For instance, when central banks in emerging markets underestimate currency risks, investors immediately sell assets, fearing collapse. In contrast, when central banks have strong reputations, like the Bundesbank in Germany, markets remain calmer. Panic comes not just from the words themselves, but from the gap between what's said and what investors believe is true. Credibility is the invisible anchor holding back chaos, the uncertainty of the future. Ultimately, markets panic when central banks speak because no one can predict the future with certainty. Every word is treated like a clue in a mystery. Are rates going up? Is inflation out of control? Is a recession coming? Central banks don't have all the answers, but investors expect them to. When those expectations clash with reality, panic is inevitable. Markets want stability, but money thrives on risk, and central banks sit in the middle, trying to balance both. Their words matter because they represent authority in an uncertain world. And when authority wavers, fear takes over.